Good morning and welcome to the Saxo Bank Morning Call. It is Tuesday, March 19th, 2019, and we have pretty quiet markets, pretty stable markets, but I think a lot of questions that need to be answered, most certainly on the Brexit front, where we're getting a new twist in the plot, as if there weren't enough twists in this Brexit plot. Yesterday, the Speaker of the House, Bercow, moving to block another vote on May's deal, saying you can't vote on a deal that hasn't been substantively changed. It's referring to an obscure rule that apparently was last used some 99 years ago, and this has sort of thrown May's plans into disarray. She was hoping to be able to go to the EU at a summit on Thursday, having, of course, a vote in hand. Where does this head next? Does she have to get a delay now of a short duration and then rework her deal and then put that up for a vote, or does this turn into a longer deal? Do we have a full Brexit next Friday? We don't have any answers. The surprising thing to me, we can look at a chart, is not seeing a lot of volatility in sterling because we still are none the wiser on where all of this heads. I would say this does sort of alter the plot, but we still don't know the outcome at all. And in terms of course, May's deal would have been the most obvious sort of route to sterling strength. I think getting that passed, getting clarity, even with Brexit, the clarity there providing, of course, impetus for capital flows and investment into the UK economy and a clear path forward. That's been disrupted. We may still get that May deal, but it's going to be on a different timeline potentially. We just don't know what's going to happen next. So I think the stakes and the last-minute nature of this whole situation getting it more and more, pointed at this point. We'll see what happens next. I think the next 24 to 48 hours very critical. Talk, of course, of a constitutional crisis over this situation in Parliament. Now, the other big issue this week, and we've talked about it yesterday, is the FOMC meeting on Wednesday. The expectations there are for a rather dovish turn. There's not a lot of expectations for volatility because we already have markets almost around the world on a sort of maximum risk-taking attitude coming into this event. It leads me to believe that even if we do get the Fed taking this dovish turn, we have a sell the fact setup. But I'll be cautious on that. We had a very strong comeback in risk appetite. As for the dollar, look at the chart here. Euro dollar, we've reversed fully back from that post-ECB sell-off. We haven't yet taken out that trend line. We'll have to see what the price action, how it shapes up post-FOMC. A bit hard to get excited about upside options as long as we're not seeing more positive data out of the Eurozone economy, so we'll have to keep our eyes on that. Now, in terms of the dot plot expectations, we have a chart here showing the dot plot from the December meeting. The red lines, I've just sort of drawn in where the consensus was at the time for this meeting, where the Fed's median forecasts were in December. The expectations are that they will lower these slightly, but look at where the market is. That's the green lines, and you're seeing that it's actually at or slightly below current levels. So the Fed is going to have to follow suit there to justify the market's anticipation around this meeting. Ole, if we look at the gold market, you would expect with so many expectations around Fed dovishness, we have the ECB also providing that very dovish impulse into the market. You'd think gold would be a little bit more excited.
You would have thought so, but I think the main obstacle for gold right now is really the continued risk on we're seeing across global stock markets. We saw that big sell-off in December and the subsequent rally in gold, and that was really a large trigger for the upside we've seen so far in gold. So far, stock markets remain well supported, and I think that is probably one of the key reasons. But if you look at the chart here, there are some supports coming in. As John mentioned, the euro dollar has recovered, the dollar has weakened, so that's adding some support. But also bond yields, and with that also real yields are continuing to point lower. This is the red line there is US real yields inverted, so you can see that correlation between gold and real yields. As real yields comes down, you remove some of the opportunity cost of holding gold. So
you've got the yields just for extra clarity on the right. That's an inverted, so as yields go lower, that red line goes higher, which you would think would drive more gold strength.
It should do. But as I said, because of we still have to remember that a lot of people, investors in gold, they buy gold as insurance. They're not looking for big gains. They're just looking at it for insurance if something else happened in the other investments. And as long as stock markets continue to move higher, that insurance is not really required. But also just take a look at the chart once again. As you can see, we are in this upside again. This is more from a technical stance, so that's more your area, John. But it looks like to me like we have a bit of a bear flag there. So there is a risk if we break below 1300 once again, that there could be an extension back down to at least down towards the 1275. So the market's a bit nervous.
Yeah, that would fit as well with a Fed that is a bit less sort of dovish. Now that it's engineered such a dramatic comeback, perhaps wants to reserve that sort of two-way potential if it feels that there's the risk that they have to hike rates at some point.
And reading the news this morning, it's the market is definitely gunning for a dovish Fed. So the risk is It's probably building a little bit to the downside.
A little bit asymmetry for sell the fact, but we'll see. Just a couple of charts to run through here as well. Emerging market equities, I think another place where we're seeing the pricing the Fed dovishness. We see that ETF, the MSCI emerging market ETF out of the U.S. Poking at those highs since, let's call it since last summer, late last summer. And on the DAX, we're getting up interesting territory. The 200-day moving average coming up around 11,785. And if you look at some technicals, put on a MACD indicator, you're seeing a little bit of divergent momentum there. So if we start to roll over, we start to get confirmation of that divergent momentum, meaning a bearish setup. But let's see the Fed's reaction, or the market's reaction, is to the Fed tomorrow. It is the key event risk for the week, and we're hoping, at least as FX traders, for some volatility. We had very suppressed volatility. Now, before we get to the calendar, you've got a few thoughts on the grain market.
Yes, because as I mentioned yesterday, we've seen this record short right now, providing a bit of support into the grain market. But then yesterday we had the weekly export data. They come out every Monday at 4 o'clock CET. And if you look at the tables here, this is the corn on the top, wheat on the left. You can see these are the weekly export numbers that's being reported into the U.S. authorities. And you can see both of them are trailing the 5-year average, and something like wheat, the bottom left there, you can see there was quite a bit of a collapse recently. 350 was the 350 tons was exported last week. The expectations were gunning for somewhat higher, between 400 and 700. So once again, you can see the wheat chart there on the left. On the right, we have recovered 38.2%, normally associated with a weak correction within a strong downtrend. So obviously, if we don't break above 464, there is a risk of some additional downside. And if we just look at the next one, this was the one I showed yesterday. This is what is providing a cushion to the market. Speculators are already holding a record short in grains for this time of year, and that is helping to provide some support. If any good news hitting the market, it is triggering some short covering. But we just talked about this before we went in, because there's now news from China that this swine fever they have has now resulted in 1 million hogs being slaughtered, being killed over the past period. And obviously that is a lot of additional soybeans that they don't need, and that's also helping their efforts to keep the soybean stocks ample while they're not buying from the U.S.
Yeah, and I guess for the grains, at least the weather bit doesn't come in until a bit later in the season.
No, that's into April. So I mean, there's some big discussion going on around the table at farmers in the U.S. right now. What should we plant this spring? Because it's really been, they're stuck between a rock and a hard place.
Right. Okay, let's get to the calendar, and we do have a busy calendar for the rest of this week. Today, some UK data. We've had those average weekly earnings heading higher and higher. But the market not really responding yet in sterling terms. Let's see where that heads. But of course, Brexit is on the menu for sterling and for UK assets. Then we have the German ZEW survey. The interesting thing there being the sort of the expectations component has been back and forth. It's sort of stopped declining, but the current situation component of the ZEW is basically in free fall. So it'd be interesting to see the latest status on that, a sense of the momentum in the actual conditions on the ground in the German economy from that survey. And then tomorrow, of course, the FOMC meeting, and we have basically a deadline for the May Brexit vote. That was the original idea, but is this going to happen at all? I think that's a headline-to-headline situation for the Brexit. There is not on the calendar here, we do have this EU summit on Thursday and Friday. Could be interesting headlines coming out of that, both linked to Brexit and on other initiatives across Europe. They're going to be breaking up soon to head for the campaign season of the EU parliamentary elections. And then Thursday, we talked about it yesterday. We'll add some comments as the week progresses. The Norges Bank, the sort of the outlier among central banks, expected to actually hike rates by 25 basis points to bring the rate to 100 basis points for that deposit rate in Norway. All right, I think plenty to look after. Market volatility is certainly not there. Amazing to see such a high risk appetite, certainly with a potential, I'm not going to call it a train wreck, but a potential train wreck and a potential big risk off event if something goes amiss with this entire Brexit situation. So let's track that closely. Let's track how the market deals with whatever the FOMC delivers tomorrow as well. That's it for today. We'll be back tomorrow with the Saxo Bank Morning Call. Thanks for joining.